Your bank account feels like the calm in a financial storm. No crashes, no stress. But that calm comes at a cost. If you're relying on a savings account to protect your future, inflation is quietly undoing your hard work. So stick around because I'm breaking down why the safer choice might be the one that's slowly sinking you and what to do instead. Now, most people keep money in the bank because, it feels safe. Your balance doesn't swing up and down like the stock market, and with FDIC insurance covering up to $250,000, it seems pretty untouchable. That stability is comforting. You open up your app, you see the same number and just think, perfect, my money's completely secure. But here's the catch with that. That sense of safety isn't free. Inflation quietly chips away at your cash year after year. And over the long run, inflation in the US has averaged about 3% annually, though it did hit 9% in 2022, which is the highest in 40 years.
Prices are rising at the fastest pace in 41 years. The consumer price index for June jumped 9.1% compared to a year ago.
Okay, let's take a quick example here. So let's say that you put $10,000 into the bank earning 1% annually for 10 years. On the surface, you end up with about $11,000. But if you factor in the 3% annual inflation, that $11,000 only buys what roughly $8,400 will buy today. That number in your account, it looks stable, but your real buying power is actually shrinking.
That's nearly a 25% drop in purchasing power without you ever seeing a red number.
Exactly, Tiara. And that's what's crazy about the whole thing, right? You only notice it gradually and slowly. There's no big drop on any given day. So if the bank isn't really protecting your future, what about index funds that seem much riskier? So if you've ever checked stock prices during a tough year, you know how wild the swings can get. Seeing your investment dip isn't exactly a confidence booster. But let's zoom out before making any judgments here. So historically, the S&P 500 has delivered an average annual return of about 10%. And after adjusting for inflation, that real number is closer to 7% per year. Now, that's not a straight path upward, as there have been many crashes and recoveries in that time frame. But across decades, the power of compounding means that money invested in index funds usually grows much faster than inflation will eat away at it. All right, so let's run through another quick scenario here. So let's say that you put the $10,000 that we talked about earlier into an S&P 500 index fund as opposed to the bank and leave it alone for 10 years. With a 7% real return, that money could grow to about $20,000 after inflation. No complicated stock picking or market timing required at all. And sure, you do have to stomach the market's, ups and downs, but over the long haul, the numbers are on your side. And now is a good time to say that if you're into investments that quietly outperform the system, you'll want to subscribe as I do my absolute best to simplify smart investing ideas like this in many of my videos. So even though banks, going back to this, look steady at first glance, right? Index funds, despite their wild days, they tend to win the marathon. Well, not so fast. Let's look at what real risk actually means for your money. Okay, so now that we know all this, what's actually riskier, right? Watching your account balance, bob up and down, or leaving your money somewhere that it quietly loses value every year. Now, it's easy to get spooked by short-term drops in the stock market, but those drops are balanced out with gains over time. Think about it this way. Would you rather see $10,000 sometimes drop down to $9,000 in your investing app, knowing that it could bounce back and grow bigger, or see $10,000 with very small increases yearly in your balance that inflation is just chipping it away at year after year? Index funds definitely deal with more drama up front, but they protect your ability to buy things over time. Banks keep your dollar steady, but not your spending power. The real safety isn't just about avoiding a scary screen, right? It's about making sure that your money grows enough to keep up. And the right plan isn't just picking one or the other, right? But actually matching your money moves to your goals. So let's go ahead and break down when a bank account is a smart choice and when an index fund actually makes more sense. Now, a bank account is great for your emergency fund and short-term money, rent, groceries, or car repair that you didn't see coming, right? You don't want this cash exposed to market swings when you might need it at a moment's notice. Now, if you do go this route, make sure at a minimum that you use a high-yield savings account. I personally prefer Marcus from Goldman Sachs because I know that it's backed by a huge, stable, and safe company, and it's also FDIC insured. So if you want to try it out yourself, click the link below in the description to get 0.25% more interest on your money for the first 3 months. But when you're looking to grow wealth for the long haul, like for retirement, or just letting your cash work harder than you do, index funds are tough to beat. Now, historically, they've delivered average returns that absolutely crush what banks offer, and they power through inflation over time. So if you use each for its actual strengths, you'll set yourself up so that day-to-day surprises don't mess up your future plans and your long-term savings actually keep their value. So now you've just seen how banks and index funds each serve a purpose, but the way a bank works can be even more shocking when you have a deeper understanding. So in this video here, we dig deeper into how banks actually profit from your deposits and what you can do instead to actually grow your money faster. Go ahead and check it out.